So this is a quick response video about AOC, Alexandria Ocasio-Cortez, who a couple of days ago made the proposal on 60 Minutes that America should tax the top income earners in America a top marginal tax rate of 70%. And this is also, I guess, a response to some of the left-wing supporters of this idea, and specifically guys like David Pakman. Now, I've been watching David Pakman for a very long time. He's a very good YouTuber, a very reasonable guy. I do agree with a lot of the stuff that he says, but when it comes to this particular issue of the taxes that he seems to support, I think he's completely off base, and he's completely wrong, and I'm going to demonstrate why in a minute. So the first thing that he speaks about, I mean, he made a video a couple of days ago about this issue. First thing that he talks about really is this nonsensical idea of supply side economics, what he calls supply side economics, or what's more well known as the trickle down effect or trickle down economics. Now, the first thing I have to say about this is that anybody who talks about trickle down economics as a serious economic event or as a serious economic policy is clearly ill-informed about economics, because you're going to struggle to show me a real-world practical example of where such a policy has ever been implemented. It just doesn't exist. And I know a lot of people are going to say, well, Reagan did this, Reagan did that. That's a joke. And if you read a little bit into exactly what Reagan did with taxes, you'll understand that it was nowhere near what people talk about and what people refer to as trickle-down economics. That concept just doesn't exist. The only people that talk about trickle-down economics are politicians who are looking for votes and looking to blame the opposition for economic problems, and leftists who seek to do the same thing, blame the rich and blame the ruling, what's the word I'm looking for? Blame the governing party for the country's economic problems. It just doesn't exist. So that's the first thing. The second thing that David Pakman speaks about in his video is diminishing marginal utility of the dollar, and I'll address that in a minute. That's the core of this video. He then also quotes what Ocasio-Cortez said on 60 Minutes about people paying their fair share. Now, let me address this real quick. When you talk about paying your fair share of taxes, let me put something in context here. I'm going to spout a few statistics that come from both the IRS as well as the Congressional Budget Office. Very, very quickly. So the first thing is this. If you look at American households, the top 20% of households paid 43 cents of every dollar of federal taxes of all kinds. Let me repeat that. The top 20% of households in the US paid 43 cents of every dollar of federal taxes of all kinds. And that includes individual income tax, payroll tax, excise tax, and corporate income tax. So when you talk about fair share, what exactly are you talking about? If the top 1% of households pay 26% of all federal income taxes, which is more than the 17% share of the nation's income, what exactly do you mean by pay your fair share? Right? In contrast to that, if you look at the bottom 50% of taxpayers, those with an adjusted gross income of below $40,000, they earned 11.6% of total adjusted gross incomes, right? but this group only paid 3% of all income taxes in 2016. Compare that to the top 1%, and those are taxpayers who earned an adjusted gross income of $480,000 and above. They earned 19.7% of all adjusted gross incomes, but they paid 37% of all federal income taxes in the US. So the top 1% of taxpayers accounted for more income taxes paid than the bottom 90% combined, who paid around 30.5% of all incomes. And this comes from the IRS. So you can't dispute it and say, well, this is wrong, you left out this. This comes directly from the IRS, the people that collect tax in the US. So what do you mean by pay your fair share? And lastly, what is your fair share of somebody else's hard work? What makes you think that you deserve a portion of what somebody else worked for? It just makes no sense to me. But let's move on. David then goes on to talk about the diminishing marginal utility of the dollar. And basically what he means here is that the more money you make, the less you need. The more money you make, the less you need to spend, or the less you can spend it on. So if you're making $500 million a year, what do you need an extra 1, 2, 3, 4, 10 million for? That money is just going to sit in a bank account doing nothing, therefore its utility is zero. This is the central, well, it's not the central argument, but it's the argument that he's making, that that money is better off in the hands of someone poor being spent than sitting in a bank account doing nothing. This is flawed reasoning. Where David finds this diminishing marginal utility of a dollar concept is in one of those research papers that he cites, which was done by MIT back in 2011, if I'm not mistaken. And this study actually talks about the elasticity of taxable income. And the problem with that study, which has been spoken about for years now, is the fact that the assumptions that are made for that particular equation, which basically gets the elasticity of income for the top 1% at a very, very unrealistically low number, those assumptions are basically, not only are they incorrect, but they ignore other research that has been done over the last 20 years on that very subject, which point to a much higher elasticity for the top 1%. But we'll get to that in a second. But that's where David gets this idea that there's a marginal or diminishing marginal utility of the dollar. So going back to his example of money sitting in a bank account, he seems to equate money sitting in a bank account as being zero utility. In other words, it's useless. That's not true. Utility can not only be defined via consumption, it can also be defined via other measures. So let's use the example that he spoke about with money sitting in a bank account. When money sits in a bank account, it doesn't sit in a bank account. It gets given out as a loan, right? So it doesn't have zero utility as you assert, or as David asserts. I'm not sure if he's listening to this video or not, but yeah, it doesn't have zero utility. Every single bank in the world, whether it be a retail bank or a private bank, will have a division that is solely dedicated towards finding loans, right? They will want to find these rich people who just have cash sitting somewhere, and they will get these people to bring their deposits into the bank so that they can give out these deposits as loans at higher interest rates, right? And the reason they do this is because the way that modern banks make money is through their net interest income. What that means is that the interest that they receive on their assets, which are usually loans, has to be higher than the interest that they receive on their liabilities, which are the deposits. So in a modern world, in modern banking, net interest income is how banks will make their money. So deposits that come in from these wealthy people are going to have some type of utility, because utility is not just consumption. And let's think about who these loans are given to. These loans are given to entrepreneurs, to farmers, to small business people, to first-time home buyers, to people who are looking to buy cars in terms of installment sales, to speculators who are going to go and speculate in the market or property or whatever it is, to all kinds of people who will then turn around and become productive off the back of those loans. And the more people produce, right, the more the farmer plants and harvests, the more the entrepreneur produces, the more the small business is able to offer his services, the higher the gross national income, right? And the higher the gross national product. In other words, the more goods and services are produced in a nation, which translates into higher gross national incomes, which is then taxed, right? So you have higher tax revenues as well. So to take it all the way back, again, you can't say that money sitting in a bank is going to be more useful in a poor person's hands than it is sitting in a bank account. That's just simply not true. Here's the other reason. Let's assume that you go ahead and you give this money to poor people instead of keeping it in a bank account. What are they going to do with this money? They're going to go and spend it, right? There's going to be an increase in general consumption. They're going to go and spend it on food, on clothes, on services, on things that they need. Except they're being given this money for free, and there's not going to be a commensurate increase in production as with if this money is being given out as a loan by a bank, right? So you have an increase in consumption without a commensurate increase in production, and what tends to happen in that type of situation is that you have this little thing called inflation that tends to pick up, right? Because you're spending more than you're able to produce in the economy. That inflation then comes back and hurts those very same poor people much harder than it will rich people. And not only does it hurt the very poor, but it also hurts the middle class, because you're going to have interest rate increases in order to try and halt and in order to try and prevent inflation from increasing even further, right? So people who have mortgages are going to have to pay higher interest rates on their mortgages, on their credit cards, on their car payments. If you are a small business owner that's taking a loan, you're going to have to pay higher repayments on your loan. If you're trying to expand your factory or your manufacturing plant, you're not going to be able to do so because the rates are going to be a little bit higher and it's going to be a little bit more expensive. All of this results in lower domestic production in the economy and therefore lower national incomes over the long term, which basically hurts economic growth over the long term. It hurts economic growth, it hurts employment. So on the whole, I just don't see how giving money to the poor for free, which is going to simply increase consumption without increasing production, how that's better than if that money is given to a bank, given out as a loan, and as I've demonstrated, will have a much more productive outcome than giving that money to the poor directly. The other thing that we don't talk about here is incentives. I mean, if you're giving people money for free, what's the incentive for them to actually be productive in the economy? There just is none. Whereas if people know that they have to pay for it, I think that's much more of an incentive to be productive. So that's that. And then we come to the historical evidence where you talk about how during the Eisenhower era, the top tax rate went up to 91%. Now, you are 100%, Mr. Pakman, when you say that we've had a 90, let me not say we, because I'm not an American, but you're completely correct when you say that America had a 91% top marginal tax rate. However, that doesn't tell the whole story. Yes, the marginal tax rate was 91%. However, the effective tax rate that people actually paid was around 45%. Right? So that's the effective tax rate. Nobody actually paid 90%. Right? So that top marginal tax rate was actually between 70% and 91%. Nobody paid that much. That's because of various things, legal and tax loopholes, people not declaring their income as income, maybe declaring it as dividends instead of income and charitable contributions, things of that nature. But nobody paid it, and we know that nobody paid it because if you look at the uh, income as a percentage of GDP between 1953 and I think 1963, at the end of Eisenhower's term, um, average income as a percentage of GDP stood at an average of 7.5%. All right, so income tax stood at an average of 7.5%. That's pretty low on average. That's pretty low on average. So that just demonstrates that people didn't actually pay this, and not only that, but it demonstrates that um, increasing that top marginal tax rate does nothing to increase the amount of revenue that's collected. So that argument really does nothing to help your case in terms of looking at the history of tax rates in the US. Now let's head to the central issue, which is this diminishing marginal um, utility of the dollar. Now, the study that David cites is an MIT study that was done back in 2011 by Peter Diamond and Emmanuel Sayers of the University of California. Now, there's a couple of issues. When I looked at the study, the very first thing that I saw is that it was done alongside Thomas Piketty of the Paris School of Economics. Immediately, that's a red flag because if you look back at his book, Capital in the 21st Century, he makes a number of mistakes in terms of the mathematics, in terms of the statistics, in order to come to some of his conclusions, which basically support a global wealth tax. And if you look at this particular MIT study, this proposal for a top marginal tax rate of 73 and 83% is exactly that. It's a global wealth tax. Now, there's a couple of problems, just aside from Thomas Piketty and the statistical stuff. A couple of problems with the way that they've come to the conclusion that a federal tax revenue would not be impacted in a negative way should the top 1% earners be charged between 73% and 83% a top marginal tax rate. The first issue is this. In fact, this is the main issue, is that the way in which they get to the figure of 73% is by using an elasticity of taxable income figure of 0.2 and 0.25. Essentially, what that means is that the incomes of rich people are so inelastic above a certain amount of money that even if you were to tax them highly, they really wouldn't care. That's, I mean, in simple terms, that's as simple as I can describe it. But it doesn't really matter whether you understand ETI or not. What you need to understand is how they got to that figure and why that figure is incorrect. So the figure of 0.2 and 0.25 for the ETI, or the elasticity of taxable income, in their book is incorrect. It's incorrect because, number one, they don't tell us how they got to that figure. And number two, they seem to ignore every other piece of research that's been done on ETI, and there's a lot of it that's been done, that seems to suggest that ETI is a lot higher than 0.2 and 0.25. The only way you can get to a tax rate, an optimal tax rate or revenue maximizing top tax rate of between 73 and 83% is if you have an ETI of 0.2 and 0.25. But that 0.2 and 0.25 is not correct. How do we know this? We know this because if you actually go back to 2004, Mr. Sayers of the University of California, who co-authored this piece of research, he himself goes on to say that the elasticity of taxable income of the top 1% is 0.62. This is back in 2004, he said this. All of a sudden now, he says it's 0.6. Okay, that in and of itself is not really evidence. It doesn't say anything, right? Maybe the guy's just changed his mind. But why do I think he's wrong? I think he's wrong because none of the other pieces of research that have been produced seem to support a figure of lower than 0.5. Like I said, there's been a lot of research done on this particular issue. So if we start from the beginning and we look at a recent survey of 30 different studies. And this survey was done by the Canadian Department of Finance. They found that the ETI estimate, or the elasticity of taxable income estimate, in the international empirical literature is around 0.4. Right? That's across all tax brackets, across all income rates, or all income earners, 0.4. So that's not really what we want to know. We want to know what is the real ETI for the top 1%. What is their elasticity of taxable income? For this, we can look to a piece of research done by Harvard in 2009 by Raj Chetty, which basically says that empirical literature on taxable income elasticity has generally been found to be pretty large, or to have a pretty large range of between 0.5 and 0.5 for individuals in the top percentile of income distribution. 0.5 to 0.15. Again, even if you take the lowest amount, which is 0.5, as a base case, that still doesn't get you to as low as 0.5. In that very same year, in 2009, Bradley Heim, who is a Treasury Department economist, estimated that the ETI for the top 1% is 1.2. And what he defines as the top 1% is people that make $500,000 and above. And if I'm not mistaken, the top 1% in the US today starts at around 350,000. So he estimates that it's 1.2. We can carry on and look at other studies. In 2010, a study by Anthony Atkins of Oxford University and Andrew Lee of the Australian National University, they found that the ETI is between 1.2 and 1.6. In 2000, a study done by University of Michigan and Johns Hopkins, as well as the Indiana State University, they found that the elasticity of the top 1% is between 1.6 and 1.99. And as I said, going back to 2004, Saez himself says that the elasticity of the top earners in the US is 0.6. So if you look at all those pieces of research, none of them go as low as 0.2. So how do these guys come up with the figure of 0.2 and 0.25? It makes no sense. If you were to then take the midpoint of all these estimates and all these pieces of research that have been done over the years, you take the midpoint, it would basically confirm that the ETI is around 1.3. Okay, and at an ETI of 1.3, that means the top earners could be taxed, or at least the revenue maximizing top marginal rate would be 33.9%. That's if you took the average of all these studies, which is 1.3. That means the rich could only be taxed 33.9% of all taxes. And with federal taxes, it would be below 27%. What a big difference that is between a tax rate of 33.9%, if you're looking at an average ETI of 1.3, and a top tax rate of 73 to 83% if you're looking at an ETI of 0.2%. I hope I've made that point clear. The issue here is that they don't describe and they don't explain where that 0.2 comes from, or which research, what survey they took. It's just a figure that they've plugged in, and that's a big problem. And for that one reason alone, that research can't be taken seriously, and it cannot be used as the basis for arguing and proposing a top marginal tax rate of between 73 and 83%. It's just flawed. It's as simple as that. The second issue with that piece of research is that even if it was somehow correct, which I just don't think it is, one of the issues that is ignored in that research is the fact that they don't estimate what the potential impact would be in the long run on not only economic growth, but also on tax revenue collection. Now, maybe in the short term, you might be able to make a lot of money, but as I've shown already in this video, even if you increase top marginal tax rate, it doesn't really increase the amount of money that you can collect, because the top 1% is made up of very few people. But as an economist, if you're going to make a policy prescription based on a piece of research, you ought to have, as a matter of professionalism, you ought to have at least some type of scenario that describes what the potential impact is on the economy, in the long term, as well as on long-term tax collection. And they don't bother to do that in this MIT research. And again, for that problem, it can't be relied upon and it can't be used as a policy proposition. You can't put in place a policy that has no predictive outcome as far as the long-term consequences of its implementation. That's just dangerous, and it's pretty stupid. So my conclusion to this video is that I don't believe it's correct to simply steal what people have worked for. I don't believe it's correct to simply expropriate what people have worked for in order to fulfill some type of arbitrary moral right that you think you have. It's theft. It's as simple as that. People have worked hard for this money, whether they inherited it, whether they, it's an investment that was lucky, whether they won the lotto. It's their money. They came about it. They got lucky. Whatever it is, it's their money, and they deserve to have it. Just because you aren't fortunate enough to be in that tax bracket, it doesn't mean that you get to prescribe what they should do with their own money. So I think David Pakman is very wrong. I think Alexandria Ocasio-Cortez is very wrong on that issue. And I think, as well-intentioned as she is, she simply doesn't understand what it is that she's calling for. And they do say that, the road to hell is paved with the best intentions. And I think if her policy propositions are in any way implemented or taken on board, I think America would be very well on its way to a very deep hell. And that's it. If I'm wrong about anything, if you disagree with my video, please comment in the comment section below, or make a responsive video. I'd love to hear what your opinions are about this. And that's it for now.